The fourth guest for our Gold Summit is an old favorite for our longtime readers. After 15 years in financial markets, Tim Price established his own wealth management company, Price Value Partners, in 2015. Out of 190 funds, the firm has come top of CityWire's performance ranking for 3 consecutive quarters. Tim has also written books, including The War on Cash and Investing Through the Looking Glass, to help everyday people protect and grow their wealth in an increasingly bizarre world. Tim's warnings that too much government debt would eventually come to haunt the developed world are beginning to play out in financial markets. But how should investors adjust their portfolio for threats that might only play out once in a lifetime? And how does gold help them do it? Find out from our hosts Nick Hubble and Tim Price.
Tim, it's good to see you after so many years. We've met so many times in person now, but not for, I think, 4 years or more.
Yeah, good to be back, Nick.
Yeah. So let's dig into your catalyst for the gold price in 2025. You emailed me. It sounds nice and simple, but it's not. We're going to get into some interesting and intriguing angles here. You wrote the deterioration in Western government budgets, and you also added the fundamental impossibility of paying back the debt load is the key. So take us through your thesis and how this applies to gold.
So I'm not picking on the US in particular. I'm just citing the US because they're the largest economy. You probably know the figures as well as we do, which is US national debt officially is something like 35 now, fast approaching $36 trillion. That's trillion with a T, growing at the rate of $1 trillion every 100 days or so. We've long passed the point of no return on that. So that money realistically is never going to get paid back. Or rather, if it gets paid back, it'll get paid back in devalued dollars. And I think 10, 20 years ago, you had Alan Greenspan at the Fed acknowledging this, basically saying, we will never struggle to service our debts because we can always print more dollars. But he said the quiet part out loud, which was then we can't guarantee the purchasing power of that currency. So it's abundantly clear, and it's been abundantly clear throughout all of financial history, that there comes a point when heavily indebted sovereigns reach the point of no return. And then the only question is which market blows up first? Is it the bond market, or is it the currency, or is it perhaps both?
So how big in terms of GDP, in terms of population, is this debt problem? I think you mentioned in a recent piece is £100,000 per household next year in the UK. Obviously, there's a lot of moving variables, but why is this becoming a problem now, rather than there's been people warning about this for many years? Yeah,
I mean, as you probably know, we've been working together in a writing capacity for some time now, and I think my book, a joint effort book, The War on Cash, was published as far back as I think 2015. So these, and then the book that was a sort of follow-up to me was Investing Through the Looking Glass, which was published in 2016. It's now getting on for a decade past that, and the irony is that in both cases I was keen to get them both into print as fast as possible because I wanted to be on record before the markets blew up. So the irony, of course, is that we're now sitting here 8 years after the fact, but now it finally seems like it's really starting to happen. So it shows, if nothing else, that things take longer to play out than you ever thought possible. But when they do start to play out, they then play out faster than you'd expected. So again, as we were talking just before we came on air, market timing, I think, is impossible. All you can do is recognize that something fundamentally has changed and it's gone wrong. So why it's happening now? I think the main reason it's happening now is because we had the most extraordinary last gasp of sort of money printing during the COVID crisis. And as a result, that probably tipped sanity over the edge, full stop.
That's just one of the signals, I think, that we're reaching some sort of constraint or endpoint in this bloom of debt all around the world.
Yeah.
We've had the inflation, as you say. We had some bond crises play out, places like France, the UK under trust. Higher interest rates is another example. Higher taxes in the UK. We've also got some foreign adventurism, which you identify as being relevant to this debt boom.
That's Ukraine and the sanctions, et cetera, et cetera.
Yep. So how did those fit into the thesis? Are they signals that something is going to snap soon, or is it signals of a constraint, or how?
I think they're accelerating the endpoint, whatever form that endpoint necessarily takes. And I think in my view, it's likely to be probably a combination of higher yields and an inflationary crisis and possibly a maybe terminal fiat currency crisis. So Just to cite one of those factors in particular, I was unaware of it at the time, but I had a very intelligent friend pointed out fairly early on in the Ukraine debacle, or whatever you want to call it, that even at the height of the Second World War, there's an entity called the BIS, the Bank for International Settlements, which is often referred to as the central bank's central bank. And my friend pointed out that even at the height of the Second World War, a hot war involving pretty much everybody in the world, one way or another, even at the height of the Second World War, the BIS never dared to touch Germany's foreign reserves. Whereas months into this, I would say, somewhat confected conflict, and I'm not pointing fingers of blame, but I'm saying that NATO probably bears a fair amount of responsibility for it, fairly soon after that war erupted, the US in particular was perfectly happy basically to not fanny around, steal Russian foreign reserves. It is impossible to overstate the significance of that at a geopolitical level. So once again, we've got a country that's 36 trillion in debt, heavily dependent on the goodwill of foreign creditors, foreign lenders, central banks and sovereigns to keep that debt show simply on the road. So at a stroke, they basically signal to every unaligned country, you can't trust us anymore. So it is no surprise to see that the likes of China and Russia have been actively disinvesting from US Treasury bonds and buying gold instead. So if you wanted just one factor amongst many competing sort of horses galloping towards the edge of the cliff, whatever the appropriate analogy is, I'd say it's the Ukraine, the complete lack of geopolitical sanity on the part of the Americans.
Yeah, I hadn't connected that trend in my mind to the debt. I saw it as just a geopolitical play, but it is closely related because the Americans are borrowing from someone.
Exactly. So where's the money coming from? And I think the only way you can otherwise mitigate that, if it's possible to mitigate it, is you have the kind of capital controls, financial repression that people like Russell Napier have spoken about, which is you effectively oblige. We're sort of halfway there already. We're halfway there here in the UK, because if you're a pension fund, you've got to own gilts. That you're not really allowed to own anything else.
Banks too.
And banks. So we're along this journey already, but that's when it really goes into overdrive. Is you won't be allowed to invest in anything else.
Yeah, and the obvious solution here is the gold is the big alternative that all these people can go to escape. But before we get to that, I want to throw you a curly one. But Tim, interest rates are so low and controlled by the government that surely all this debt we've accumulated doesn't matter.
It's an interesting thesis. But what effectively it amounts to saying is we can have faith in centralized government, big state policy, the directed economy. And the entire history of the 20th century suggests that the big state command economy doesn't work, or it works for a period of time and then it blows up. So one of many instances you could cite would be the example of the Soviet Union. So the Soviet Union, born in the chaos of the Russian Revolution in 1917, and pretty much from every year since, you'd have objective observers, non-Russian observers, saying this cannot last, it's going to fall apart. The Berlin Wall didn't fall until 1989, so you had 2 or 3 generations. So even a dysfunctional system can outlast everybody, but it still fails in the end.
So we've got this big debt load. There's various ways that this massive debt load can unravel and not solve itself, but correct. We've got inflation, we've got default. How are you expecting things to unfold?
If history is any guide, and I think inevitably it will be to a certain extent, it'll be a combination of higher inflation, stickily high, messily high, uncontrollably high inflation, mixed with almost certainly higher bond yields. And at a certain point, the bond market and the currency market will interact, because the kind of fiscal discipline that's required to address the bond problem will not be there, because it's impossible. It's like trying to shrink a big state that can only ever grow. So there'll be an exit valve of some kind. It'll be either bond yields spiking uncontrollably higher, or it'll be the currency being forcibly collapsed, or a combination of the two. And this is again where gold comes in, because one of the less acknowledged beauties of gold is that it's an asset that unlike government debt or fiat currency is nobody's liability. Gold does not depend on any entity, any counterparty for its credibility as an asset. It's completely independent. It floats above the fray of geopolitics. And that, I think, we're in such an extraordinarily challenging world that one characteristic is probably worth more than any other.
Yeah, I agree, and it's not one that's often mentioned. Take us through some other ways that gold is the solution to all these problems. You mentioned the counterparty side, you've mentioned the geopolitical side. One I want to ask you about actually is the rotation out of bonds and into gold, because you started out as a bond salesman.
Yeah. So you've got the great thing I'd say about the bond market. So I came into the city by accident, really. I didn't plan on a career in finance. I read English at university, so it was an accidental journey for me, but I just quite enjoyed the ride. The bond market is a great place to sort of, as someone who didn't read economics at university, the bond market is a great place to give you a schooling in the fundamentals, the basic fundamentals of things like economics, economic growth, GDP, inflation, interest rates, the interplay of all these things. And I think the bottom line is basically that ever since 1971 and since Nixon took the dollar off gold, we've been in an increasingly unstable global monetary situation. And it'll be the bond market. I think the reason why the bond market is so crucial is the bond market dwarfs the size of the equity market. People don't appreciate that because the media, the mainstream media or the legacy media never report this. So the best you'll get is maybe a reference to mortgage rates occasionally. But the bond market by size dwarfs the value of equity market capitalization across the world. So whatever's happening in the bond market, it's like a kind of a great deep sea undercurrent of, you know, this is the fundamental reality of the world. And then the equity market is kind of like froth on top of that. There are trends, and they say they've been moving in the wrong direction for quite a while since the 70s. The debt pile collectively has just got too big. So the way we express this when we're talking about it with clients or prospective clients is there are problems and there are predicaments. Problems can be solved. The debt market situation is now a predicament. It can't be solved. It can only be dealt with. And then the question is it going to be dealt with in an orderly or disorderly way? I think the problem is that the rise of the big state everywhere in the world has meant that the problem is now going to be dealt with in a disorderly way.
What does an orderly way even look like?
Well, an orderly way is, if you remember when we had this supposed period of austerity about sort of 10, 15 years ago, and it's an attempted slight shrinkage of the state. But the problem is now so huge that short of basically cutting the economy in half or cutting government, we may yet get there because, of course, we now have this Department of Government efficiency, the ruse that's been sort of spoken about by Trump and Elon Musk. Maybe they'll actually get there because the guy did great business with dismantling the workforce of Twitter. So if you can do that, maybe there is hope for us.
And we have Javier Milei in Argentina.
Indeed, there are some early signs of good news out there.
Yeah. I can't imagine it going well from here. But even if it does go well, what's the outlook for gold? Because I simply cannot see any realistic way that the debt mountain can be usefully addressed. That for me, the adverse side, the obverse side of that coin is that gold prices continue to rise. And I think gold is perhaps the most misunderstood asset on the planet because it's treated along with everything else, and so everyone compares and contrasts. But we have, if you're a believer in Austrian or classical economics, you need to have sound money. In other words, if you don't have sound money, then you can't price anything really quite properly. So very intelligent people have said, if you're trying to value gold, say using the dollar, which is an impermanent, constantly changing store of value, then that's like trying to measure a suit using a piece of elastic. The only answer is you throw away the elastic and you wait until there's something that has more tangible store of value quality. It's like there's a scientific definition for what a kilogram is. It's the mass at a given altitude, at a given temperature of a certain block of material in a university room outside Paris somewhere. So we know what a kilo is. What's a dollar? There is no scientific definition of a dollar anymore. So people are looking at the gold price the wrong way around. The issue is not what the gold price is or what gold is worth. The issue is what's the dollar worth. And in extremis, as financial history tells us, in extremis, it'll be nothing. It'll get there in the end. It may or may not be in our lifetimes. But that's the problem with the whole fiat currency system. It's not backed by anything except politicians' promises. And we know from the last few years just the value of politicians' promises. So something has to change about the system. You've criticised the dollar very heavily there. I would be even more pessimistic about the pound, which adds what to the gold investor story?
You're just seeing the same thing through just different prisms. It's like a hall of mirrors. So you can price gold in anything you like. You can price it in dollars, sterling, euro, yen, renminbi, you name it. But gold will be the last, if you like, currency standing, because it's not, to repeat the point, it's not dependent on any counterparty for its value. It's universal, and it's independent of the political system or the geographic system. So for thousands of years, it's been the last man standing. There is no recorded history of any fiat unbacked currency that's ever lasted. And the pound's actually done relatively well on that basis. But ultimately, we know where this is headed. We've seen this film before. We saw it in 1923 in Germany. We saw it in Zimbabwe. We've seen it in Hungary. We've seen it through time and time immemorial. We know how this story plays out. The only question is how long it takes.
So let me try and sum up the thesis, and then you add or disagree with anything I've got wrong. So I think your point is that we are reaching an end point.
I'd say the monetary point of no return.
Yeah, and we're hitting the constraints now, and we're seeing some of the symptoms that this is going to go wrong. At this point, we have only bad choices left, or realistically, that's all we're going to be choosing.
It's like the old Irish joke is, you wouldn't start from here.
Yeah, which makes life difficult for the politicians who do start from here. All of this looks good for gold. There's several different ways this can still go, but let's talk about timing, because that's always been the challenge for this thesis,
sure.
Right? Assuming that you're even going to try timing it, but investment to a great extent is about timing. We've seen these symptoms that things are starting to go wrong, and they arguably already have, and they've started to go right for gold. Does this just sort of continue as it's been going for the last year and a bit in terms of the gold price rising and things going wrong in the bond market for the last 3 or 4 years? Or is this a long process? Is this, like you said earlier, it all happens faster than you expect? What are you expecting things?
I mean, I hate to resort to cliche, but as the old line goes, how did you go bankrupt slowly and then all at once? So again, the financial markets don't operate in a linear way. So to go back to the analogy of the avalanche, you can tell the best you can do as an investor is to detect when the snow mass on which the snow is falling has shifted from being in so-called stable equilibrium to unstable equilibrium. And then the best you can do is simply identify that it's no longer a safe place to be and get the hell out of Dodge. You can't predict which snowflake is going to cause the avalanche. In the same way, you can't predict what geopolitical or economic development is going to cause the final collapse. All you can do as an investor is to be prepared for that ahead of time. And then you just use things like standard procedures like pound cost or dollar cost averaging to avoid the worst of the volatility.
Yeah, I often feel like I'm running around trying to figure out which snowflake it is that's going to trigger the avalanche in my articles and news, which is good fun and interesting. We all like to discuss what caused 2008 type crashes. Obviously, with the pandemic, we know that, but that is not the way people should be investing.
No, I mean, the way the stance we take is we try and be kind of safety first investors. So we'd cite the classic lines by people like Warren Buffett, which is rule number 1, don't lose money. Rule number 2, see rule number 1. So the way we mitigate some of these things is if we identify a game we don't want to play in, which in our world is the bond market, we just don't play in it. So we have other investments. And I think that's the sort of perverse thing about the situation we're in, that I think it's quite easy to identify what the red flags are. The difficulty is in then deciding which things you can still invest in sensibly. And for us, clearly gold is one of those things. So and even the language needs to be somewhat refined, because you need to be very careful of your terms. Someone very, very intelligent said once that gold is not even an investment. It is, quote, a conscious decision to refrain from investing until the return of an honest monetary system makes a calculation of relative asset prices possible once again. So it's not even speculative. It's something much. It's like investment to the power of 10.
Yeah, even though we've sort of been told to think about it as a speculative investment in a way by the mainstream, the whole
because
point,
it's being priced in fiat currencies, which are themselves inherently volatile.
Yeah, and so under this unstable monetary system, it's money, it's cash in the bank that is just disproportionate.
Whereas I think strictly legally, globally, gold is money, and as JP Morgan, the banker himself, said, everything else is just credit.
Yeah. Are we going to see a return to that being acknowledged, that JP Morgan quote, or is the fiat monetary system going to take on another, perhaps even more absurd iteration?
I forget the name of the author, but there's a book, The Once and Future Money, Gold, The Once and Future Money. And that book, I think, cites an economist who points out how aberrant it is, how unusual it is that we've had a monetary system in the last 50 years where the monetary system has not been backed by anything tangible. And that economist's argument is that the 21st century will see gold perhaps return, maybe not as the entirety of backing for global money, but as part of it. it is very easy to foresee some kind of a development, perhaps including the so-called BRICS or BRICS 2 or BRICS plus economies, where you get a monetary system where the currency is in part backed by, let's say, hard commodities.
That's why it's impossible to overemphasize the importance of this Russia story, because all of a sudden everyone has been forced to realize exactly what you just said, that they can no longer trust the fiat system internationally. They need something else. What's the obvious alternative? Gold.
For sure.
So take us through who we is. You've mentioned we a few times. Price Value Partners, you're writing your fund. Tell us all about it.
So Price Value Partners was set up by myself and a colleague of mine, Killian Connolly, back in 2014. We're a small team. We manage discretionary money for private clients. We also manage one fund, which is the Price Value Portfolio. And there are really three legs to the stool which we put our investments upon. So we believe in value investing per people like Ben Graham and Warren Buffett. We believe in what we call in correlated funds, which are systematic trend following funds, a momentum-based strategy that's worked very well over the last 30 or 40 years. And now the lion's share of our assets, both in the fund and in our managed account portfolios, are in what we call real assets. And for real assets, read tangible, non-financial things that if you drop them on your foot, it hurts. That includes the likes of gold, silver, related mining concerns, and claims on the real economy rather than pipe dreams.
Last but not least, what's something we can look forward to that'll happen in 2025 that will confirm your thesis and cause gold to surge?
I suspect, or we suspect, that the inflation problem has not been addressed. It's merely sort of biding its time. So an upsurge in inflation, possibly linked to an upsurge in bond yields internationally, would cause gold to get another, having had a bit of a breather of late, will cause gold and probably silver as well, which I think is even more heavily undervalued, to have the next surge upwards. And if you like gold, you can imagine why the authorities might want to, let's say, tinker with the price of gold, because for gold to be going up is basically a warning sign that everything's gone wrong with the economy. So you can see why the monetary authorities would be keen to, let's say, keep the gold price subdued. But as Mrs. Thatcher said, you can't buck the market. You certainly can't buck it forever.
Yeah, it feels like that surge in inflation and bond yields may have already begun.
I agree. I think you're right. So, the authorities, the central banks can buy a bit of time by printing more money, but that only makes the problem worse. It's not addressing the problem, it's merely delaying it. In the same way that 2008 gave these guys a classic opportunity to reset the system, and instead they just chose to flood the system with money and give it to bankers in the form of bonuses.
So you might be right before we even get to 2025.
Well, that we were talking just before we came on air, that I think that the guys who are long-term cycle theorists have a property cycle that runs in like 18 and a half or so years, and their forecast is for the markets to blow up in 2026. So maybe you have one more year left of good times, and then it's off to the poorhouse for the people who don't own gold.
I can't end any better than that. Tim Price, thanks very much for coming on.
Thank you.